Good morning, everyone, and thanks so much for joining us again today. Welcome to our third and final installment of our Pay As You Earn webinar series. Today's session is where it all comes together and where we will focus on the more advanced aspects of Pay As You Earn, like fringe benefits, allowances, taxable income deductions, and tax credits. My name is Jamie, and I'm joined by Musa, who will be co-hosting with me today, as well as Brandon from our training team and Darren from our customer experience team, who will be presenting on today's topic. As a reminder, episode 1 focused on the determination of Pay As You Earn on regular income, while episode 2 focused on irregular income.
Hi everyone, I'm Darren, and I'm once again joined by Brandon.
How's it, Darren?
Hi Brandon. Today we'll be discussing the Pay As You Earn calculation with fringe benefits, allowances, taxable income, deductions, and tax credits. Before we start, let's do a poll. Should appear on your screen any minute now, and then we'll go through it together. Okay, so the poll question, you should see it now. The statement is fringe benefits are generally subject to tax, while allowances are usually tax-free. It's a true or false question. We'll give you a few minutes just to answer that, then we'll go through it together. Okay, so the results have come through. So we see that 41% responded with true and 59% responded with false. Brandon, is false the correct answer?
False is the correct answer, Darren. And the reason for that is that both fringe benefits and allowances are subject to tax. So the allowances portion of that question there, that part is false. So the answer there was false.
Okay. I would imagine that it's a common misconception that either benefits or allowances are not taxable. Why are both benefits and allowances subject to tax?
Well, if you think about it from Sars's point of view, right? If Sars allowed either fringe benefits or allowances to be tax-free, so in other words, that they wouldn't tax it, then employers or companies would stop paying employees their salaries and would simply pay them in benefits and allowances. They would say, okay, I'm not going to give you a basic salary of 10,000 or 20,000 or whatever it might be, but instead I'm going to give you benefits. So I'll pay for your groceries, I'll pay for your rent, I'll pay for your car, I'll pay for everything that you need on your behalf. And that way you could avoid paying tax. And the same thing happens with allowances, right? So allowances are generally there to offset any business expenses. And if SARS allowed allowances to be tax-free, then companies would simply pay these enormous allowances to their individuals in order to avoid them having paid tax. So they would say things like, okay, I'm going to give you a 10,000 Rand cell phone allowance, knowing that you're never going to spend 10,000 Rand on your cell phone for business purposes. So for those reasons, they are both subject to tax.
Okay. And also, as you pointed out, there is a benefit that's derived. For example, with the cell phone allowance, there's no guarantee that the employee will use that allowance simply for business-related use, right?
Absolutely.
Okay. Thanks, Brandon. This far, we've only been including income within the Pay As You Earn calculation, but we now know that benefits and allowances are taxable. How do these impact the Pay As You Earn calculation?
Okay, so that's a great question. I think I'm going to start by sharing my screen. So let me just stop the screen share. Okay, so you should be able to see my screen now.
That's great.
Okay, great. So you'll remember that in episode 1, we looked at total remuneration or total year-to-date regular income, and we said that was 20,000 for Peter Pan in March and 25,000 for him in April. And this focused on basic salary only. We then went through the calculation and determined the PAYE based on this. Now, what we can actually do is we can expand this definition of total remuneration. So previously, we're only focused on basic income, or basic salary, sorry, which is an income. And now we're going to actually expand it to include a formula. And that formula consists of 2 parts. So the first part is remuneration. So remuneration equals your income plus your benefits plus your allowances. And then from your remuneration, you can derive your remuneration for PAYE, which is your remuneration less any taxable income deductions. Or in other words, your remuneration for PAYE purposes is your income plus your benefits plus your allowances minus your taxable income deductions.
Okay, that's pretty clear. Now, Brandon, in this formula, you're not accounting for any reimbursements. Why is that?
So that's a good question. And reimbursements are not subject to tax. And I think it's important for us to distinguish between reimbursements and allowances. So yes, with allowances, we expect the employee to spend money on a particular business expense. But like you said, there is no guarantee that the employee is actually going to be spending that money on the business expense. So let's say you give them a cell phone allowance and you say, okay, we're going to give you 1,000 Rand towards phone calls for business purposes. There's no guarantee that that employee is actually going to be spending 1,000 Rand on phone calls for business purposes. And that's why it's taxable. On the other hand, when we look at reimbursements, a reimbursement is not a fixed amount like an allowance. Instead, the employee would come to you and they'd say, okay, here are my receipts. Here's what I spent on my cell phone, or here's what I spent on stationery, or whatever the business expense might be. And you would then reimburse them for that exact expense. So for that reason, right, there's a burden of proof with allowances, with reimbursements that there isn't with allowances. And because there is a burden of proof, there's a guarantee that that employee is actually spending it on those business expenses.
Okay. Okay, so there's no benefit derived from the reimbursement value because it has all been used for business-related expenses. Okay.
Exactly.
Now, with allowances and benefits, are these amounts 100% taxable?
So that's a good question. In general, yes, there are the full value of the benefit or the allowance is taxable. However, SARS has identified certain common benefits or certain common allowances that come up, and they've actually got rules in place for how you determine the value of that benefit or how they might be taxed. So there might be some things that are not necessarily 100% taxable because SARS has got a special rule in place for that. And you can actually find out more about that in the SARS guides. So remember, previously we spoke about the employer's guide in respect of employees tax. And yeah, they very briefly do talk about your allowances and benefits over there. So you'll see allowances and fringe benefits, but they actually have separate guides for them. So you'll see here's a SARS guide for fringe benefits. And sorry, there's actually the front page. So guide for fringe benefits. And yeah, if you scroll down to the table of contents, you'll see a list of all of the benefits that SARS has identified as being sort of your common benefits that they want to provide more information on or maybe special rules on. And the same thing when it comes to allowances. Here's a separate guide for allowances, which breaks down 3 allowances that they actually identify as being common or something that they want to put a special rule on.
Okay, so there are special items taxed at a different or taxed differently than a general allowance or general benefit. But for everything else out of the scope that's covered in the guides provided by SARS, it's assumed that it would be taxed 100%. Is that correct?
Yes, that is correct.
Or 100% of the amount. Okay. Brandon, I see that in your formula, you actually mentioned taxable income deductions. Let's do a quick poll to see if our audience can identify what impact this has on pay as you earn.
Sure.
So you should see a taxable income deduction poll here. Let's go through the question together with a statement. A taxable income deduction indirectly, put in the missing word, the pay as you earn that an employee pays. There's 2 options, reduces or increases. We'll give you a few minutes just to answer that before we go through it. The results together. Okay, there we go. We are getting the results back. So 74% responded with reduces and 26% responded with increases. Brandon, what is the correct answer here?
So the correct answer is reduces. So well done to the 74% of the audience. You're spot on there. Right, so remember that if you look at this formula over here for remuneration for PAYE, you'll see that taxable income deductions, they reduce your remuneration for PAYE. So that remuneration for PAYE, we're going to take into this calculation to determine your annual equivalent, and we're then going to use your annual equivalent to determine your tax for the year, and then once we have the tax for the year, we're going to de-annualize that to determine your PAYE. So essentially, what's happening here is that these taxable income deductions are reducing your remuneration for PAYE, And because it's reducing your remuneration for PAYE, your annual equivalent will be reduced. And as a result, your PAYE would be reduced. So well done to the 74% that managed to link all of that together.
Thanks, Brandon. Brandon, okay, so we understand that the annual equivalent is basically affected. It doesn't immediately doesn't reduce the pay-as-you-earn calculated at the end of the calculation. Now, what payroll items would qualify as a taxable income deduction?
So there are one or two, or there's a few different items, but the one that is relevant to payroll is your retirement funds. And when we're talking about retirement funds, we're talking about your pension funds, your provident funds, and your retirement annuity funds. So when we talk about taxable income deductions in the context of payroll, we're talking about retirement funds.
Okay. Why would Sars allow you to reduce your taxable income?
So essentially what they're trying to do is they're trying to encourage certain behavior. And when it comes to your retirement funds, they are trying to encourage you to save towards your retirement so that when you do get to retirement age, you don't have to rely on the state to look after you. So they're trying to ease their burden. And because they're trying to ease their burden, they want to encourage you or incentivize you to save towards that retirement. And that's why they allow you to essentially pay less tax if you do contribute towards retirement funds.
Okay. Brandon, with all these components, is it possible to take us through a numeric example of how pay-as-you-earn would be calculated with each of these components of the tax formula?
Yes, absolutely. All right, so I've actually got an example that I've put together over here. So fairly simple example. So it says an employee earned 20,000 Rand in March. Let me just scroll in a bit. Okay. There we go. An employee earned 20,000 Rand in March and 25,000 in April 2022. So I'm using the same figures for Peter Pan that we used in the previous episode. So basic salary of 20,000 and 25,000. From April 2022, they also received a cell phone allowance of 1,000 Rand per month, a medical aid company contribution of 2,500, and a retirement annuity fund company contribution of 2,000 Rand. The employee contributes 2,500 to the medical aid and 1,500 to the retirement fund. So the first step that we have to go through is to actually put together a formula. So what I've done is I've just broken it down here. I've got income plus your benefits plus your allowances gives you your remuneration. And then we're going to subtract the taxable income deductions to get our remuneration for PAYE. So let's start with our income. Our income would be your basic salary, and that's the only thing that we used to work on in episode 1 and 2. And that's 20,000 and your 25,000. So that's fairly simple. And then we're going to start adding our benefits. Now, benefits are usually when the company pays for something on your behalf, or they give you something for use in your personal capacity. So maybe they give you a laptop and they say, yeah, you can go and give this to your niece or your daughter or your wife or your husband or whoever it might be, and we don't want it back. In that case, the fringe benefit's going to arise. Or if they pay for something on your behalf. So they say, okay, you have an Edgar's account. I know you're struggling to pay it off. We're going to pay it for you. Don't worry, you don't have to pay it back. Very generous. But yes, that is a benefit. So in this instance, you'll see that there's two things that the company pays on behalf of the employee. The one is the medical aid company contribution. So that's your medical aid. And that is 2,500 the company pays. And the second one is your retirement fund. Okay, and that is 2,000. So the total benefits for this employee is 4,500. And you'll see as I added this, it increases the remuneration and in turn increases your remuneration for PAYE. Just by the way, I also just want to, I know this is slightly off topic, but I just want to stress that the reason why we break it down as remuneration first and remuneration for PAYE is because remuneration gets manipulated differently for UIF, PAYE, and SDL. So that is why it is important to break it down, right? So when we go from remuneration to remuneration for UIF, it's going to be a slightly different formula. And then remuneration for SDL is actually the same as remuneration for PAYE.
Okay. Thanks for adding that, Brandon.
No problem. All right. So now the next thing is to enter any of the allowances. So you'll see here that it says that the employee received a cell phone allowance of 1,000 Rand per month. Okay, so cell phone, and that is 1,000. And again, that is added, so it increases our remuneration. And now it's going to be time to deduct our taxable income deductions.
Brandon, while we're on the taxable income deductions, so we see that the employee contributes and the employer contributes. How do we determine the taxable income deduction amount? Is it simply the employee contribution, or is it both the employee and employer contributions?
So both the employee and the employer contributions can be deducted, provided that it is below the limits that SARS prescribes. So there are two limits that SARS has. The one is an annual limit of 350,000. Now, in this case, you'll see that this employee is unlikely to reach that 350,000 limit in the year, and we are only in the second month, and this is the first time that they're actually contributing, so it's definitely going to be well below that limit. So for the purposes of this exercise, I'm actually going to ignore that 350,000 limit, but the simple pay system does actually take that into account.
Okay.
And then the second limit that there is a limit of 27.5% of your remuneration. So that's another reason why we separate remuneration from remuneration for PAYE, is because we have to first work out what is the limit for this taxable income deduction based on our remuneration figures.
Okay. And that's done on remuneration, not on remuneration for pay-as-you-earn purposes.
Correct, yes.
Okay.
Okay, so our RF limit is going to be equal to 27.5% times, and now we want to multiply it by our remuneration, and we're going to use year-to-date remuneration. So the year-to-date remuneration would be your 20,000 plus your 30,500. Okay, and there you'll see that we have an RF limit of 13,887 Rand and 50 cents by the end of April.
Okay.
We then want to
just to confirm, Brandon, both the 350,000 and the RF limit are checked, and that is used to determine what the deduction would then be once we've determined the RF limit. Okay.
Yeah, so now what we're going to look at is okay, what are the actual contributions that we've made year to date, and then determine whether that is below the limit or above the limit. If it's above the limit of the 27.5%, then it will be capped at the 27.5%. If it's below that, then we can use the actual contributions. And then the same thing gets applied with a 350,000 limit. So if it's above the 350,000, then it would be capped at 350,000.
Okay.
Okay, so now we want to look at the actual contributions for the year. We've only had contributions for 1 month in the tax year, which is April, and my retirement fund company contribution is 2,000, right? So that's over there. And then we've got a 1,500 employee contribution. So my total contribution is 3,500. Now, 3,500 is what we want to deduct. My RF limit is 13,887.50. So because my actual contributions are below the limit, I can deduct the full 3,500. Remember that if they had made contributions in March, we would have obviously had to take that into account as well, and we would only be able to then deduct the difference between the year-to-date contributions and then your year-to-date RF limit.
Okay. Brandon, what I see is that you included a medical aid fringe benefit, right? But you didn't include the medical aid contribution as a taxable income deduction. Surely SARS would want employees to be on a medical aid so that they don't have to use the state hospitals. Why is it not being deemed a taxable income deduction?
Okay, so you spot on there when you say that, yes, the government does want to incentivize you to pay for your own medical aid, or to belong to a medical aid, so that you don't have to then rely on a state hospital and they don't have to fund any medical expenses that you might have. And medical aid used to be a taxable income deduction, but that law was changed, and instead now medical aid is now a tax credit that gets taken into account after tax is calculated.
Okay. Let's do a quick poll before you continue, Brandon. So you should see the poll appear on your screen any minute now. The poll question is, medical aid contributions result in a tax credit, which is similar to there are two options, taxable income deduction and tax rebate. We'll wait for your answers and then we'll discuss the correct answer together. Okay, so we've got the answers back. 84% responded that the tax rebate is similar, or the tax credit is similar to the tax rebate. Brandon, is that correct?
Yes, that is correct. Let me take you through it. Just by the way, I've just had to move my desk a little bit so that I'm out of the sun. I hope you can see my face better now. Okay, so remember we had a taxable income deduction, which is our retirement fund, and that we said was 3,500, and that reduces our remuneration for PAYE. So you'll see that it went from remuneration of 30,500 to 3,500, and that then gives us 27,000 as a remuneration for PAYE. We would then move that 20,000, or that we would add together the 20,000 and the 27,000, and that would give us our total remuneration, or our year-to-date regular income. We would go through the entire tax calculation as we did in episode 1. So divided by the 2 periods, multiply by 12 to get our annual equivalent. Once we've got our annual equivalent, we then work out the tax on the annual equivalent. We then work that back to get the year-to-date tax. In this instance, there is no irregular taxable income, so we can ignore that. And that gives us our total year-to-date tax on our regular income of 6,469. And remember then we're going to subtract the year-to-date PAYE already paid in March. And year now is where it comes in the tax credit. So you'll see that the tax credits gets taken directly off the PAYE that we owe. So it reduces the PAYE liability, and essentially it is like a tax rebate compared to a taxable income deduction, which reduces your PAYE indirectly by reducing your taxable income.
Okay, so one, the taxable income deduction, we are taking it into account when we're calculating the remuneration for pay-as-you-earn at the start of the tax calculation, whereas with tax credits, we're taking this into account after we've already calculated the pay-as-you-earn liability.
Exactly. So they work similarly in that they both reduce your PAYE at the end of the day, but the way that they reduce it is slightly different.
Okay. Now I see you've got the year-to-date tax credit says 347. Where did you get this amount? Is it not determined the same way we would with the taxable income deduction, where we take the employee and employee contributions into account?
So unfortunately not. Instead, Sars actually prescribes a fixed rate for the medical aid tax credits, and that you can find on the Sars website. Again, you don't have to actually know this because the Simple Pay system works all of this out for you. We do everything on the back end. But if you want to go and double check it, you can. So on the Sars website, you'll find the medical credits page. And if you scroll down, you'll see that there are the various years of assessment that they have given you. And yeah, they tell you that it's 347 Rand per month for one person that's on the medical scheme. If there are 2 people on the scheme, then it's going to be 694 Rand in total for the 2 people. And then each additional person would then be 234 Rand after that.
Okay,
and
so it really depends on per month. Okay, so it depends on the number of members, and that determines the tax credit applicable for the specific employee. Okay, so in your case, in our numeric example case, there's only one member because you've only captured 347 as the tax credit.
Exactly. I know it wasn't clear in the question, but let's just assume that there was only one person on this medical aid, and so because there's only one person that belongs to this medical aid plan, that's 347 Rand.
Okay. Now, Brandon, let's move on to a few scenarios that I've been thinking about while we've been discussing benefits and allowances. So earlier you mentioned that there were special rules or SARS rules for determining the value of certain benefits and allowances. Can you take us through some of these?
Sure. Where would you like to start?
Let's start with a company car. I think this one's quite interesting for me. I've got employees who make use of a company car. How do we determine the benefit of the company car?
Okay, sure. So let's go to Peter Pan. He's our employee that we've been using for the last 2 episodes. And let's go and add a company car for him. Now, company cars would be under regular inputs because it's something that's going to occur on a frequent basis. So it's going to be across more than one payslip. So I'm going to click on add regular item, and I'm going to look for the company car benefit. Now, remember, when we talk about company car benefit, we're talking about a company car that an employee can take home and use in their personal capacity. So either they use it to drive to and from work, or they can use it to drive to and from work, and they can use it to go to the shops, to go away for the weekend, whatever it might be. We're not talking about company cars that sit on the premises of the employer and that can get used by every employee for business purposes, just to go and do a day trip to a client or a supplier or something like that. In that instance, there's no personal use of the company car, so there would be no benefit that is derived.
Okay.
Okay. Yes.
So, okay, so I see there's an input for Deem value of vehicle. What would this be? Is this simply the purchase price of the vehicle?
So if you just purchase the vehicle, then yes, it would be the purchase price. If it is, maybe you bought this vehicle 2 or 3 years ago, then you would take into account depreciation. So you can actually go to the Sars guide, and if you look at section 4.4, they give you a whole breakdown here of how you're actually going to go about determining that value of the vehicle.
Okay. And once you've determined the value of the vehicle, I see there's a checkbox for purchase price includes maintenance plan. What is this for?
Okay, so essentially what we're doing is we're trying to work out the value of the fringe benefit. And that's going to be your Deem value of the vehicle. So in this case, I'm just going to say that it's 200,000. And then we're going to multiply it by either 3.25% or 3.5%, depending on whether the car includes a maintenance plan. Now, if it includes a maintenance plan, so in other words, if I tick this, then we're going to multiply this 200,000 by 3.25%. If it excludes a maintenance plan, then we're going to multiply it by 3.5%. So let's say that it includes it, and we'll then multiply it by 3.25%.
Okay. And then after you've determined the fringe benefit, how does the taxable percentage work? How do we know what taxable percentage should apply to this fringe benefit?
Okay, so this 200,000 multiplied by the 3.25% gives you the value of this car in terms of the benefit. But remember that you never use a car fully for business purposes or fully for personal use. So this taxable percentage is based on how much you use it for business use and personal use. So if there is a case where you use the car completely for private purposes, so in other words, there's no business use, then it would be taxed at 100%. Otherwise, in most instances, it's based on what we refer to as the 80-20 rule. And what we're looking at here is what is the percentage that you use the business for business purposes. So the benchmark is 80%. If you use it for business purposes more than 80%, then you're going to include it at 20% for tax purposes. If it's less than 80%, then it's going to be included at 80% for tax purposes. I know this confuses quite a lot of people. We do have a help page on this that explains it, but just to summarize, so the benchmark is 80%, so more than 80%, so in other words, mostly for business, then it's taxed at 20%, or less than 80%, then it's not mostly for business, so so then it'll be taxed at 80%. Sorry, but I confused myself there.
No problem. It's very confusing, Brandon. Okay, so the business use, you make use of things like logbooks and things like that just to determine what the percentage is. What happens in the case if we had to set it at 20%, but at the end of assessment, we incorrectly set it at 20%? How would we adjust for this in future payroll periods? Or would it just be assessed or corrected at the end when the employees complete their tax assessment?
So according to the Sars guide, you are supposed to relook at this on a monthly basis. So you are, as the employer, you're supposed to go each month or each pay slip and say, is this person using this car mostly for business purposes or not? And then adjust the percentage accordingly. However, on assessment, it doesn't make sense, right, that everyone would be taxed at 80%. So if you use the business purposes, you use the car 80% for business purposes, you're going to get taxed at 20%. But if you use the car 79%, then you're going to get taxed at 80%. Now, that's quite a huge discrepancy. But again, we differentiate between PAYE and income tax. For PAYE purposes, SARS says 80% or 20%. But on assessment, they're going to look at the actual use, and then based on the actual use, they're going to adjust this, and then they're going to either refund you as an individual, right? Or they're going to ask you to pay in. So it is quite important that you do try and get this correct, and rather go for the 80% if it's likely that they're going to have to pay in, so that they don't get that surprise at the end of the year.
Okay, thanks, Brandon. While you've been talking, I've been thinking about employer loans, right? And these are amounts that are given to employees. Would these also be considered taxable fringe benefits?
So in most instances, let me actually go to the guide quickly. Let's go to the top part. Let's look for low interest or interest-free. Oops, that was the wrong one. Sorry, not debt. Oh, was it that one? Yes, I think it was.
Yeah,
okay.
yeah. Looks like that.
So there's two things that we need to consider here when it comes to low interest or interest-free loans. The first one is, what is the interest rate that you as the employer are charging the employee? Now, if this is below the SARS official interest rate, then there's a benefit that this employee gets, right? Because they getting this loan from you as the company at a much lower rate than they would if they went to a bank. So that's the one thing to take note of. And then the second thing to take note of is, what is the value of the loans that this employee has? So if it is above 3,000, then SARS says a taxable benefit would arise. If it's below 3,000, then they say you don't have to worry then about the fringe benefit. There's no value to the fringe benefit. Okay. So when we actually, sorry, can I show you on the system quickly?
Yep.
So when we actually do this on the system, right, you'll see that we're going to add an employer loan, and you'll see here we have a checkbox that says calculate interest benefit. So we put it in your hands to go through the guide and say, okay, this is below 3,000, so we don't have to worry about the interest. So you can leave that unchecked, or no, this loan is above 3,000, or the total of their loans is above 3,000. So we do need to check this and calculate the interest benefit.
Okay, and what would the interest benefit be in the case that there is a fringe benefit attracted on the employer loan?
So that would be then the difference between the interest rate that you charge. So if it's 0, then it would be the difference between 0 and then the SARS official interest rate. Okay. And then obviously multiplied by the loan amount. And then remember that interest rates are done on an annual basis. So we would then divide that figure across the number of pay slips based on the employee's pay frequency.
Okay, and that's to get the fringe benefit per payroll period, essentially.
Correct, yes.
Okay. Brandon, last week we also spoke about the voluntary tax over deduction, right? And we spoke about it during our Q&A session. I just wanted to go over it again. What is a voluntary tax over deduction?
So this is essentially, if you as an individual think that on assessment you're going to have to pay in income tax and you want to avoid having to do that, you can contribute more tax to SARS, or you can pay more tax over to SARS on a monthly basis or weekly basis, whatever your pay frequency might be. And a good example of this is actually the car benefit or travel allowance, where you tax at 80% or 20%. And you might think that on assessment, when SARS does the adjustment, you're going to have to pay in. So to avoid that, you want to, maybe you're not good at saving. So to avoid that, you want to then pay from your salary each period an additional amount of tax over.
Okay, and this voluntary tax over deduction, does it have any impact on the pay-as-you-earn calculation that's performed on a payroll, for a specific payroll period?
So we don't include it in our calculation, so we don't take it into account. And the reason for that is, if we did, we would then be adjusting the PAYE every month based on what you previously paid and including that in the previously paid figure. And then by the end of the year, you would have paid the exact amount of PAYE that you should have for your income on your pay slips, and there won't be any additional tax that you've paid over. So remember, the whole point of the voluntary tax over deduction is to be able to pay additional tax over to SARS, so we don't take it into account in our calculation of PAYE.
Okay, so SARS only takes that value into account when performing the income tax assessment.
Correct, yes.
Okay, thanks so much for that, Brandon.
Can I just add one more thing quickly? Sorry. I know we spoke just now about the tax credits for medical aid.
Yep.
I also just want to point out that, remember we said that it's based on the number of members that belong to the medical aid plan. So it is really important that when you are setting up the medical aid, that you correctly capture the members that are on this plan. So in this field over here, please do make sure that you capture this accurately, because if you over capture, so you say 4 and it's only meant to be 3, then obviously your tax is going to be reduced by the medical aid tax credit for that.
Okay, thanks for pointing out, Brandon. And Simple Pay automatically does the calculations at the back with applying the applicable tax credit.
Exactly.
Okay.
Yes.
Thank you.
Cool.
Okay, anything else, Brandon?
No, that's all. Thanks.
Okay, Jamie, over to you.